So the number one tax strategy for business owners in 2026 is the one that not a lot of people on YouTube talk about because it's boring. It doesn't make a good thumbnail and it doesn't sell a $3,000 course. But I've worked with close to 1,000 business owners, and this one strategy costs the least, risks the least, and saves more than every tax loophole that your accountant has failed to mention, but every influencer out there talks about. So today I'm ranking the 5 biggest legal tax strategies, worst to best, and you'll see exactly why the boring one wins. Plus, at the end, I'm going to tell you which one is on this list that the IRS publishes called the Dirty Dozen list. So I'm Adam Williams, Pennywise Tax Strategies, 15 years doing this, admitted to U.S. tax court. Let's go. So before we rank anything, I want to tell you how I'm scoring these because this is how we talk to every client in our business. Every tax strategy has 3 dimensions: risk, cost, and benefit. And cost isn't just the money, it's your time. Risk isn't just an audit, it's whether the strategy holds up if the IRS shows up with questions. And benefit, of course, isn't just the headline dollar figure, it's whether you're actually eliminating tax or just delaying it. So let me kill one thing up front. I hate the word hacks, and I really dislike the word loopholes. These aren't hacks and loopholes. Every strategy I'm about to rank is written directly into the Internal Revenue Code, and in most cases, subject to further interpretation in tax court. So if you follow the rules, you get the benefit. That's not a loophole. That's tax policy doing exactly what Congress designed it to do, except for one of these, and you'll know which one when we get there. All right, so coming in at number 5, retirement accounts. Every book that you read on financial planning tells you to maximize your 401k contributions, or if you're self-employed, maybe use a SEP or SEP IRA or a solo 401k, all of those things. And before you come at me in the comments, yes, I know every finance YouTuber tells you to max out your 401k. I'm not saying don't do it. I'm saying it doesn't belong at the top of this list. And here's why. In 2026, the 401k contribution limit is $24,500. That's if you're under 50. If you're over 50, you get another $8,000 to catch up. And if you're between 60 and 63, the Secure 2.0 enhanced catch up lets you add $11,250 on top of that. So that is up to $35,500 a year on the employee side alone. And if you've got a solo 401k for business owners, you can stack employer contributions on top of that. So these contributions reduce your taxable income this year, and that's real. But here's the thing that I don't think a lot of people tell you clearly enough. This is just tax deferral, not tax elimination. So when you pull that money out in retirement, you're gonna pay tax on every dollar. Or if you've got enough at stake, maybe someday way down the road, you can do a Roth conversion, but there's still gonna be time and money involved in that. So the good news is with retirement accounts, the cost to set them up is low. Most payroll providers can do it in like a day, and the risk is nearly zero from a tax perspective if you stick with the reputable custodian. Now, of course, there's always risk in investing in the stock market. But the other important thing is the benefit is capped, and it's not tax elimination. This is really just a tax timing play. So for some people, those Roth conversions later in life can help, but that's going to be a different video. And this is why retirement accounts are number 5. They're useful, but they're not the headline strategy. They're low risk, relatively low reward, and don't take a lot of time and money to set up. Number 4, real estate investing. And this is where some of you are going to yell at me because I'm putting real estate investing at number 4, and some people really love this strategy. So real estate has the single biggest potential tax benefit on this list. And I've had clients completely eliminate their tax bills. Like we're talking hundreds of thousands of dollars of income just through real estate and depreciation. So one cost segregation study on a commercial property can front load 6 figures of depreciation into year 1. But here's why it's not higher on the list, and this is the part the real estate gurus skip over. Real estate is expensive. You need a down payment, typically. You need to take on debt. And if you want the full tax benefit, there's a serious time commitment written into the IRS rules. Short-term and long-term rentals require material participation. We're talking real hours that you track every week. Short-term rentals, the rules are a little bit easier to meet with, and I actually love this as a strategy. Some people call it the Airbnb or the short-term rental loophole. But I'm going to be direct with you. The second you list that property, you're not a passive investor anymore. You're now in the hospitality business. So you're worried about marketing and staging and guest complaints and refund disputes. So this is a job. So the tax benefits are real, but so is the cost. And if you have the cash and the time or the stomach for it, This is a real wealth builder, but for a lot of business owners, it's not their first move. That's why it's number 4 on our list. All right, so my number 3 tax move for 2026, I kind of cheated on this and crammed a bunch of them together because they're related to me. Because in my mind, they're related. So number 3 is actually 3 strategies unbundling because they all essentially do the same thing. They take money you're already spending and run it through your business in a tax advantaged way. So we've got the Augusta rule. If your entity is set up properly, you can rent your personal home or any dwelling that you rent or control. Dwelling has to have sleeping quarters and a bathroom. So could be an RV, could be a vacation home, could be a boat. But you can rent your dwelling for up to 14 days a year to your business. And that rental income is completely tax-free to you personally. That's written into Section 280AG of the tax code. So the business deducts the rent expense. You report 0 taxable income. So if you have a board meeting or a team offsite or a client strategy session, or if you're shooting content, you can rent your house for that. Now, the catch is the rate has to be reasonable. There's some influencers out there that are saying, yeah, just rent your house for $50,000 a day. If you live in a house that's worth that, congratulations, good for you. You're probably missing out on some other strategies. But for the rest of us, we're talking at most a few $1,000s a day, potentially. So you're going to want to compare a space rental to like a hotel conference room or other event space in your area. The good news is they're not cheap, which means that's more money you can pull out of your business, but you need a rental agreement. You should have your meeting minutes if you're having an actual meeting, like a board meeting at your home. You can't make this up. The second category of money you're already spending that we want to use in a tax advantage way is putting your kids on payroll, or better yet, what I like to call employing your kids in your business. If you've got kids and a legitimate job they can do in your business. A lot of people like to talk about modeling for your website or social media, but cleaning, filing, social media, building websites, you can put them on payroll. And for sole proprietors and partnerships, where both parents are the only partners, the wages you pay to your own kids under the age of 18 aren't subject to Social Security, Medicare, federal unemployment tax. Plus, they're going to be at a significantly lower tax rate than you. Plus, they get to take advantage of the standard deduction. So for 2026, that's around $16,000 of earned income that your children can have before they pay any federal income tax on it. And the third strategy in my little bundle here is the home office. And there's 2 methods to do this. There's this safe harbor method where you can just write off $5 per square foot up to 300 square feet of your home office. So this is like an easy $1,500 deduction with not a ton of real documentation required, but that's not a huge benefit. There's also this actual expense method. It takes a little more work, but if you've got a legitimate dedicated office, it's usually a lot more money that you're going to save. Now, you either need to be a sole proprietor and you can do it the easy way, or if you've got an S Corp, you can set up an accountable plan for reimbursements. There's a lot of nuance to that, but again, you're already spending the money to pay for your home with your interest and your property taxes, and you've got maintenance and insurance and upkeep and things like that. And now you're going to be able to take a portion of that and reduce your tax bill. So all 3 of those together with Augusta and employing your kids and taking advantage of the home office, that can pull another $10,000, $20,000 a year off your tax bill. And it actually, with the home office, opens up some additional strategies that may be available to you. So the cost is basically 0. You're already spending this money. The risk is low if you document it properly. And that's why this bundle is number 3 on our list. Number 2, your choice of entity. This is actually where we start a lot of conversations with our clients. But determining how your business is going to be taxed, because in most instances, you have a choice. So roughly 90% of small business owners never make a tax election with the IRS. They file their LLC and assume that the LLC was the strategy. It's not. Your LLC is a legal structure created under state law. It doesn't really do anything for your taxes on its own. The IRS has its own classifications. So you could be taxed as a sole proprietor or a partnership or an S corporation, or if you set up a C corporation. And if you don't make an election, they pick one for you. And most of the time, it's not the best one for you. Surprise, surprise. So if your business is clearing maybe $50,000 a year in net profit and you're taxed as a sole proprietor because you are a sole proprietor or you're an LLC that never made a different election, you're going to end up paying 15.3% self-employment tax on every dollar of that profit. On $150,000 of profit, that's like more than 21 grand in self-employment tax alone before you pay income tax. So when we look at choice of entity, often we'll consider an S corporation election where you would pay yourself a reasonable salary from the business. Reasonable is a magic word when it comes to lawyers and tax law. And then you take the rest of the profit as a distribution. The self-employment tax only applies to the salary portion. So if you've got 150,000 in profit, the average client can save 10 to 15 grand a year potentially every single year on the same revenue and the same profit. So this is tax elimination that pays you back year after year after year. Now, one word of caution, the IRS, of course, has a reasonable compensation rule. And there was a famous case on this, that's Watson versus Commissioner, where this taxpayer paid himself $24,000 of wages on $200,000 of profit, but he was working full-time in the business, and the IRS recharacterized a lot of that. He was just trying to disguise his wages as distributions. So he lost. Don't lowball your salary. There's a whole lot of homework that you have to do on this, and you can look at salary reports and Bureau of Labor Statistic records and things like that. And I've actually done some other full videos on S-Corp elections, including when you should do it and how to set the salary. So the link of that will be in the description. But for this ranking, entity choice is number 2 because it's a one-time decision that saves you money every year forever. And number 1 on our list of the top tax strategies for 2026 is going to make some of you roll your eyes because it's the least sexy thing on this entire list. It's your bookkeeping. I've worked with close to 1,000 business owners, and here's what I can tell you. Most small business bookkeeping is really, really bad. It's often so much worse than the business owner even realizes. And bad bookkeeping costs more than every other strategy on this list combined. So I'm going to give you 2 real examples. A client of ours bought a bunch of computers for her office. She was doing this massive expansion, but she used her personal credit card for it because she was getting more points for that. And she handed the receipts for those computers to her bookkeeper, but the bookkeeper saw the personal card and didn't record them as expenses. This was tens of thousands of dollars of legitimate business expenses gone because the bookkeeper didn't care to ask the right questions. So we caught it when we were wrapping up her taxes, and we had the business reimburse her through a formal expense reimbursement, and we ran that deduction through property. So the net to her was thousands of dollars of tax savings that she would have just walked away from. And it's all because her bookkeeper missed it. Got another example. We had a client that's got a multi-million-dollar business, and like many of us, she's running a lot of her expenses through a credit card. You should see the number of Amex points that I have. So she's running like $100,000 a month through her business credit card, and her bookkeeper missed a full month of those expenses, just didn't record them. So her books were overstated. Her profit on her books was overstated by over $100,000 that year. She was about to pay an extra like $30,000 or $40,000 in tax on money she'd already spent on legitimate business expenses. We caught it on the review, but that's why this is number 1. The cost of bookkeeping is low. The cost of good bookkeeping is very low. But the cost of bad bookkeeping can be tens or hundreds of thousands of dollars. So with your bookkeeping, the time cost to you is minimal. You review your reports once a month or maybe more, and you just gut check to make sure that they're accurate, plus you use those numbers to help run and grow your business. And the risk is extremely low because good bookkeeping actually reduces your risk with the IRS. And it's the only strategy on this list where the cost is low, the time is low, the risk goes down, and the benefit compounds year after year after year. Plus, your business is going to be more successful because you have good bookkeeping. So every strategy above this, the entity selection, the Augusta rule, real estate depreciation, every single one depends on clean books. If the numbers underneath are wrong, the strategy on top is wrong too. That's why bookkeeping is number 1. All right, so I promised you at the start I'd tell you which strategy is on the IRS Dirty Dozen list. And I want to talk a little bit about syndicated conservation easements. And there's a new version of these that has come out, but we're starting to see more guidance from the IRS and more tax law that interprets these things. So with this tax strategy, the IRS has listed this on its Dirty Dozen list for several years. And here's how they work. You can buy into a piece of real estate through a syndication, and you legally, or the syndicator legally separates the development rights and then donates them to a conservation charity. So the syndication claims this charitable deduction. The problem is the amount of the deduction is often 4 or 5 or 9 times what the investors actually paid for the property. So what they paid for the property, a sliver of those rights, the development rights, is somehow worth multiple times what they actually paid. So the investors get these massive tax deductions, the syndicators get these huge fees, but the IRS has been coming after these for years, and they've passed some specific regulations targeting these things. And the problem is a lot of the companies that sold these deals weren't built to fight the IRS, so they actually settled, I think, a little too soon. the clients paid back the savings that they got on their taxes, plus penalties, plus interest in some cases. Some of these companies are still in litigation 3 or 4 years later with millions of dollars of legal fees just to defend the position. So are there a few legitimate conservation easement structures? Yeah, a few companies are still fighting the IRS and may ultimately win their specific cases. But the broad category, the syndicated pitch that lands in your inbox with 4x your money on your tax deductions, that's the one that's on the IRS Dirty Dozen list. So the cost is high, the benefit is high, but the risk is high. And we don't like that combination of these three things typically. So if it sounds too good to be true in tax, it often is. And this is one of those things. So here's your playbook. Start at number 1, get your books clean. Then layer number 2, make sure you're in the right type of entity, which is something that you should analyze at least annually. And number 3, 4, and 5, as they fit your situation. Every strategy higher on this list makes the ones below it work better, so do them in order. And if anyone pitches you the bonus syndicated easement, the too good to be true tax shelter, you now know exactly what that is. So in the next video, I'm going to deep dive on this S Corp election from number 2, the salary question, the documentation, how to stay out of this Watson versus Commissioner territory. So if you're running an LLC with real profit and you haven't made this election yet, that video is going to save you money. Adam Williams, Pennywise Tax Strategies. See you there.